All right. So last time we are looking at how to identify institutional structures because whatever you're going to do in chart analysis comes from the understanding of the market movement, where the market is heading to, where we're having a reversal, and we're still in a continuation state. So what we can see here now, this is the daily time frame, and this is basically Euro USD, and we can see this has been trending to the upside, and we can clearly see from this particular price delivery, we have price created this swing low point, but then we had a failure of movement to the upside to break this high to create a new higher high point. And what we can see is that price fell to the downside, taking out this low point, leading to a market structure shift. And in extension, also, price is about to take out this strong low point that created this high point. So basically, here we have a break of structure here. We have a valid break of structure because we can see volume closing above previous price swing points. So we have a break of structure there, and we can clearly see that price took out internal liquidity in the form of trend line liquidity. So we have the rate of the internal range liquidity. Price went for the external, took out the external liquidity. So basically, what we have is that price gave us a high point here, which is a higher high, printed a higher low, price created this higher high points. Now we're expecting to see the pullback of price, and here we have the pullback of price to the downside, creating this low points. So basically, these are all internal structures. They are not actually trying to tell us that the market has changed direction to a bearish movement. We're together, right? All right. So all of these are just internal structures because when you drop to a lower time frame, you're going to see bearish market movements within this pullback. So basically what I'm saying is here we have what we have here is we have the impulse from this newly created higher low to this high point. That is the impulse. And what we have here is the corrective leg move. So when you drop to a lower time frame, basically this is going to be structures. Let's check the 4-hour time frame. You would clearly see that. So what we can see here from the 4-hour time frame, you can see basically within that price movement, we're having bearish structures. Now price gave us the pullback, but you can see that is why we said that the market is fractal. You would see structure in higher time frame. You also find structure in the lower time frame because you can see now we have the fall to the downside. We have a market structure shift here because this is the last swing low point that printed this high point. So we have market structure shift, fall to the downside, a pullback, price fell, broke this low, a pullback, price fell, broke this low. We had this deeper pullback to the upside, price fell again, broke this low. We have another pullback, price fell again, broke this low. So you can see that when you're using a time frame lower, you're going to find a lot of price delivery. So whenever you're confused in identifying structures, that is why you need to go to a time frame higher than the time frame where possibly you're having confusion in establishing the valid structure. So here we have the corrective leg move. So basically our expectation is to see how from this newly created low points, we're going to have an impulse movement to the upside that's going to take out this high point, then we know we are continuing bullish. But what we can now see is that price here from this swing low point failed to take out this high. And then we had the price movement ending here. So this is just giving us a sign that we are failing to have higher prices because prices failing to take out this high point. Same price failing to take out this high so that we can continue bullish. And then what we can see is the fall of price now to the downside. So we can see price failed to print a new high point, and then we have the pullback leg move back to the downside. And now what we can see is that the institutions took out this low point. This is a weak low point because it failed to take out this external range liquidity and price broke through it. So we have what the market structure shifts here. So this is where we begin to look out for the bearish movement, or if you don't want to take this as a market structure shift, then you can wait for price to break the strong points, which is basically this low, because this low sponsored the impulsive movement that broke this previous high points. So now we can still consider this as our market structure shifts because already from the swing points, we already have a shift in the state of that delivery. We're already seeing that price is failing to create a new high point. And now we had the push of price to the downside that went further to break this swing low point. So we've established now that we're having the tendency of a reversal to the downside. And basically, I told you that when the market is moving, we're having bearish movements, price will create this. For price to continue further bearish, price will seek this buy side liquidity. Basically, what the institutions do is just to keep seeking liquidities in the markets. So the institutions will seek the liquidity at the swing high because they believe that buy stops, retail stop orders will be here, and then they would rate those orders, and then you would see they sponsor the bearish movement back to the downside. So the institutions will still create another manipulative movement and then sponsor a movement to the downside. Upon the return again, they would want to seek internal liquidity. And you can see this exists as relatively equal high points. They will seek those liquidities and then sponsor price again to the downside. So basically, we want to be looking at zones that will serve as inducement liquidities. So all of these zones are internal swing high points that are going to serve as inducement liquidity zones. Once the institutions take out the external range liquidity, they seek the internal range liquidity. That is what they basically aim for because liquidity is what provide the movement in the market. So what we can see here is we have this market structure shift. Now we can clearly see the structure we are having. The fall of price to the downside. We had a pullback, another impulse to the downside. We had this pullback. Let me clearly identify those stuffs. So we had the fall here to the downside, this pullback, a fall. We had the pullback. We have this fall and a valid pullback. A fall here, a valid pullback. We continue further again to the downside. We had a fall here. We had a valid pullback. A fall here, a valid pullback, and then a fall here. So what you can clearly see from the chart is we have bearish structure within this movement to the downside. So what you can see is once price created this low point that broke the previous swing low point, creating the market structure shift, we can see where is the most recent high point that the institution printed. This is the most recent high point. So when we are having a bullish movement back to the upside, meaning this becomes the draw on liquidity. It means this becomes the next draw on liquidity. So the institutions want to seek this liquidity first, the buy side liquidity, before we have what the bearish continuation, since we've already established the market structure shift. And basically, you can see we have fair value gaps here, fair value gaps here. The, the movement of price to the upside had the probability or possibility of returning back into this fair value gap. But basically, the institutions will still move price just the way they want to. But we can see they respect this swing high points, this up close candle before this bearish impulsive movement. Because clearly what you can see also is that this swing high took out liquidity of this previous high point. So this swing high point took out liquidity. So it's also a valid swing point to consider to take an entry from because this has already seeked liquidity and then sponsored this bearish move. So now clearly what you can see is price return to the upside, took out this liquidity. So basically this is trying to tell us that we have an established low point and this is the established new low point because what we can clearly see is we have this impulse to the downside. This is the swing high that gave us the impulse to the downside that led to the market structure shift, meaning it took out this external liquidity, created this low. So for us to validate this low point, then we want to see the movement to the upside that will seek an internal liquidity. And we can clearly see here that price seeked this internal liquidity. which is our inducement liquidity. So price took out the inducement, and what you can see now, we're having bearish impulse back to the downside. So for us to have a breakout structure, we want to see price takes out this low point, and then we have a breakout structure. Here we have the market structure shift. I told you that the market structure shift is basically what leads to reversal. So we can clearly see this is where we have the market structure shift, and now we're looking forward to see that price will take out this low points, giving us a break of structure to now establish strongly the bearish trend to the downside. So let's just play price to see how this unfold. All right. So you can see now we had the fall of price to the downside, and price took out this swing low points. So we have a break of structure there. So what validates the newly created high points is the fact that this high point now sponsored the bearish movement that took out this previous low points. So clearly you can see now we have a lower high point. So you can see we're establishing our structure now. So now we have price give us this low. We had the pullback. This is a valid low point because it seeked the internal liquidity. And now we have the fall to the downside leading to this break of structure. So now what we'll be looking at is where is the buy side liquidity. So basically, you want to look at the internal structures. What we have is that we have this from this high to this low. This is the lowest candle. We had a pullback because this went against this candle and swept the high points. We had again this fall here to the downside, and then we can clearly see we had this pullback. Now we have this fall against the downside. We have this pullback, and now we're seeing price again falling to the downside. Hello, are we together? Now we can find out that we've established the internal structure within this impulsive leg movements. So you can see we have this fall, we had the pullback, the fall, the pullback, the fall, the pullback. So this is the impulsive leg movement, and we can clearly identify the structure here. When we drop to the lower time frame, let's go to the 4-hour. You're going to see that clearly. So you can see we have structure within that. You can see that. So we have structures within that. And from the 4-hour time frame, you're going to see that we have more structure because it's going to be more clearer here. You have this fall, you had this pullback, the fall, this pullback, this fall, the pullback, the fall again, another pullback, a fall. So you can see why we said the market is fractal in nature. So back to the daily time frame where we just want to see price delivery that helps just reduce the noise. So we can see now we have this fall. So basically, where's the last swing high that was created? This is the last swing high points. This is the last swing high points we have. So basically now we'll be looking forward to see if price is returning to the upside. Price should seek this swing high point, which is the buy side liquidity, because now price created this high points. We had the impulse to the downside that broke the swing low points. So you can see also from the daily time frame, you can see we're having structures within that. But then when we go to a higher time frame like the weekly, you're going to see you just have an impulsive movement. So are you seeing here in the weekly, we just have an impulsive movement to the downside. So you can see how when you're going to higher time frame, it helps you reduce the noise. So you can see how here is just an impulsive movement. But then back to the daily time frame. So we can see now, want to see the return of price. Price should seek the internal range liquidity before we have the continuation, because we can see price broke through the swing low point, took out the external liquidity. And when you're looking forward to your inducement liquidity in a bearish market condition, the point of interest you want to identify are basically the point of interest above the inducement liquidity. And clearly what you can see, I told you that the internal range liquidity are the swing high points or low points depending on the market condition, and also the fair value gaps. So what you can see clearly here is we have this swing high. We also have this fair value gap. Let me identify that for you to see. Above that, we have this fair value gap. So basically between this candle low points and the swing high points. So we have a fair value gap there, which is also an internal range liquidity. So now you see we have, and Fair value gaps also act as sponsorship zones. They act as point of interest. You can see at times when you're analyzing the chart, you would see that price doesn't return to an order block. The price just returns to a fair value gap, and then you have price movement to the downside. So basically, when you're trading, there are order blocks, there are breaker blocks, there are mitigation blocks, there are rejection blocks, there are fair value gaps. All these are sponsorship zones that price has a tendency to react at any of them. It mustn't just be the order blocks. Are we together? So clearly now, what you can see is above the buy side liquidity, which is our inducement, you can see we have this fair value gap.